Hey guys, been a minute since I've done a video. I think a couple months now. Had a lot going on the last few months, and not a lot changed in the market the last few months. The last video I did, I had mentioned that I had gotten to full cash, which is pretty rare for me. I had seen enough things lining up to go to cash. But I didn't stay cash for too long. Made a Discord post on the 20th saying that I was seeing enough evidence that the correction is potentially going to be short-lived. So this post was on the 20th. This highlighted part here was the area that I basically mentioned that I got long on the 19th, the day before that, and I was getting more long on the 20th. And that was indexes, and I got more long posts. So here's the 19th, here's the 20th, and I added some more in some individual stock trades and some other trades along the way. And while there was a few bits of evidence to say maybe I should have locked in some profit up here, and even in my Discord post I said I was playing for a rally into mid-June because multiple factors that I laid out in the Discord. And yeah, mid-June 15th, since then we've been down, so yeah, it would have been a good place to lock in some profits. And there was a few things occurring, like SPX VUX 5-day correlations did briefly go positive. Put call ratios, option speculation got the most extreme I think we've seen yet since the 2020 lows. So there was a few reasons that yeah, I probably should have locked in some profit. Didn't do it, but there's a reason why I didn't. Hedge fund exposure from Sentiment Trader was healthy. Dix has been relatively healthy. The COT for Tech's pretty healthy, and FANG, and Dix on FANG and Dix on XLK components. I'm going to get into all these things, but they're all pretty healthy. So I am more interested in adding than I am in reducing risk here. That's currently where I'm at. There's some extremes, but not enough, and the things that I really trust, for the most part, are pretty healthy. COT, has been slowly declining, at least on the consolidated view. We're going to look at a few different views of COT in this as well. So this first chart is just the VIX and the SP 500, and basically I wanted to just do a back test of the times when VIX gets above the upper Bollinger Band, just using standard Bollinger Band settings, 20 MA with 2 standard deviation bands. Anyways, close above the bands and then close back under the upper band. That was what I wanted to back test, and I kind of highlighted some points here where that has happened. And yeah, and there's a few that I didn't highlight, and this is why you back test things, because the human mind just likes to see what it wants to see and doesn't see like, well, this one here and some of these others weren't like real significant. Those are going to be included in the back test. I also went through and looked at it for Keltner channels for wait, that's not my Keltner. I don't know what happened to the Keltner chart. Oh, I'm a little bit out of practice here, boys. It's been a while since I've done this. Yeah, I lost the Keltner one. Anyways, there's a Keltner chart, and it was actually a little bit cleaner. And I had to use a 0.1 multiplier, I believe, for the Keltner. So anyways, here is the back test for the one with the Bollinger Bands, and you can see, the VIX gets above its upper Bollinger Band, comes back below closes back under the upper after being above, and the back test is pretty positive. So if you're looking for a place to buy on this current little correction we're in, which my view could be very similar to this last one in terms of possibly depth and magnitude. We just closed above the upper Bollinger Band. If you wait for a close back under, I think your risk reward is pretty solid. I think there's a potential to go lower here. I'll get into that. And then, yeah, we could get a bit more of a spike in VIX. VIX is at 20.7. It's starting to get a bit high, and we're starting to see, you know, we've had 3 down days, and VIX is over 20 already. So yet again, I think people are, it's the March 2020 effect. People are scared of the next crash, and they're quickly preparing for a crash every time we try to correct. So this is what we keep seeing. Here's the Keltner channel backtest, and it's a better backtest because, like I said, it was a lot cleaner. There was a lot less false signals. I don't know what happened to my chart, but I'm not gonna recreate it for you guys. You can probably do it. It was just Keltner channel and VIX with 0.1 multiplier and 20 EMA, 20 ATR. This is the block trade buying thing, and I've shown this, and you have to go back and watch past market update videos to get the explanation of what this is. I don't want to explain this every time. So I highly recommend, if you want to learn kind of my method, go through and watch each video sequentially. They're long, but I think it will help a lot because I'm not going to explain every concept every single week. Anyways, block trade value, yes, it's partially related to OPEX. We tend to get bigger prints on OPEX. However, that's a pretty strong buying print for block trade. So that is one factor why I think possibly this correction could be shorter lived than I think a lot of people think. The put-call ratio, this is one of those things that I said, yeah, we had extremely low put-call ratio. You have to go back a long ways to see one that low. So yes, that was a red flag. However, they're already spiking and buying right back into puts with just a 3-day pullback. So I think we may not have too much further to go. Again, option speculation index, just another way of looking at that put-call ratio. But in my opinion, it's a better methodology. Getting back to those extreme levels again. That have been problematic in the past. However, in the past, we had to be up there for quite a while before it was an issue. So, considering, you know, there was a pretty good cooling off, and we're only recently spiking, I don't think we're setting up for a large correction here. And this is probably the main reason why I don't think we're setting up for a large correction is the DIX has been very strong, 46.5 on Friday. Really, really strong prints. You know, the momentum of the market moving down here and potentially some liquidity that could be hunted by the large players because we're right at 41.50. You could definitely see them running under 41.50, grabbing more liquidity. Getting those stops cleared out, getting a few more people in bearish positions, and then reversing. I think 4,100 has a pretty good chance to hold. Maybe there's even a liquidity hunter under 4,100. I could see that being a possibility. But I think there's enough evidence that we're not about to have a substantial correction, or certainly not a crash. I really think crash probabilities are quite low. Seems like a lot of people disagree with that, but that's my view. Crashes are always low probability, by the way. There are certain scenarios where crashes, you know, bump up in probability. I don't view this as one, but we'll see. Fang Dix, solid. 5-day average is 45%. Fang chart itself looks pretty healthy. It's barely budged in this pullback so far. And that is largely because positioning is extremely light in Fang and Tech still. and extremely heavy in commodities inflation names, like extremely heavy, and I'll get into some of that. XLK, this is the components, the DICs on the components of XLK, the top 10 components, Apple, Microsoft, Visa, Nvidia, so on and so forth. 52% 5-day average. So that's very, very constructive here. This is the ETF DICs, pretty constructive, 49% 5-day average. And you can see it's very much above historical averages. BofA Bull Bear did pull back a little bit. This is nice to see. So this is one of the pieces of evidence. 1.6 or 7 standard deviations above historical positioning in commodities. You can see that there. And tech under positioning compared to historical averages. Yeah, cash is pretty low as well. You know, bond positioning was also very low, which if bonds rally, that in theory could help tech to some extent. Although I don't think you want to see bonds just scream higher. If bonds have a nice steady rally higher, that should be helpful for tech. For me, the risk is with how extremely positioned they are in quite a few sectors here. If you get into a situation where you start seeing forced liquidations, it can be a cascading effect that could eventually affect all sectors. So if S&P 500 can't hold 4,100, this would maybe be one of the reasons why, because they start getting liquidated from here. They have to start selling other positions, even tech. Even if they're light in tech, they may have to sell tech to cover some of their margin calls. And again, the market moves based on institutional money, but in my opinion, however, it doesn't move the way I think a lot of people think. A lot of people think it's smart. Institutions are all smart money, and they're moving the market because they're buying low, selling high, and they're moving the market that way. More times than not, I think the market moves in a way to take over-leveraged institutional money out. And most of the time, the market is taking out over-leveraged people. That is usually what is happening, I think, in the market. And right now, you have people way over-leveraged in the commodity market, in inflation names, and they're getting taken out. And that's what's moving the market right now, primarily. It's not these guys, shorting the market. It's them getting forced out. Nasdaq short interest. Let's clear that out. And this hasn't been updated since May, but this whole idea that there's no bears, like in the market, that you always see all these charts on Twitter. There's no bears. There's no bears. There's some bears. There is some bears. Options OI, pretty big spike, and it was OPEX on Friday. That's where you see the spike. But yeah, they finally want some puts again, and they had been not wanting puts as much before this, so that was a red flag before this. Probably if I'd have been paying attention, maybe I'd have locked in some gains, but I didn't. I haven't been, truth be told, I haven't been super focused on the market recently because of some things going on. So kind of missed that I probably should have locked some in, but right now I think it's a bit too late. I think at this point I would rather add than sell. However, yes, you got to factor in risk management, and if we get under 4,100, I will probably be adjusting. What I typically do is it's very common to go under a level like 4,100, stop a bunch of people out, and then reverse higher. So under 4,100, I don't use like a lot of hard stops. I believe in kind of a time and level type of stop. So under 4,100, I give it a bit of time to make sure it's not a stop run. But if we're under there for a few hours, yeah, I'm just going to exit. And then if the market does wash out, great. I'll either look to buy lower, or if the market can reclaim the level that I exited at, I'll just get back in. And yeah, sometimes you play that game of, well, then it dumps back under your level again, so then I just get back out. And yeah, you can add up some fees when you do that, but that's how I play it. I don't like to get stop runned, so I like to kind of be somewhat aggressive with changing my positioning around the level that I feel that I should be reducing risk, so that I'm not stuck in a situation where I stop out and the market rips 100-point higher on me, which used to happen before I started being a little more proactive with my risk management instead of just using hard stops. So yeah, there is some open interest in index puts now, so that's a good sign. The COT, yeah, dealers have been slowly drifting lower, but they're still above average here, and it's nothing like the March 2020, right before March 2020, where crash risk was quite high because of a lot of things that we were seeing at the time. There was warning signs before March 2020, just like there was warning signs before the apocalypse, and dealers got quite short right before that. Dealers got quite short, and this didn't really work all that well over here, but it's worked pretty solid in recent history. Decided I'd show you a bunch of dealer positioning in the various futures, index futures. And yes, the S&P 500, it's not looking near as bullish as it was. So that's the big contract, or the consolidated contract, actually. And this is just the mini contract. It looks very similar. This is Nasdaq 100, however. I want to show you this because the dealers are net long and pretty close to the highest long exposure historically ever. So that's encouraging. The Dow, still fairly healthy. Russell 2000, still pretty solid, I would say. Dealer positioning, net long. And S&P 400 futures, people don't talk about these a whole lot, but dealer positioning is pretty healthy there as well. So despite the total COT dealers being kind of meh, kind of average, it's heavily affected by the S&P 500, because the S&P 500 is a huge amount of open interest, and this is adjusted for open interest. So basically it's going to look very similar to the S&P 500 dealer chart. Yeah, the reason it's not quite as low as it's not quite as low here as it is on the S&P 500 chart. See how it made a much lower low? That's because of Nasdaq and others kind of holding it up. Hedge fund exposure, it's been pretty mild and healthy, and then spiked really hard the last few days. However, the times where we've had the bigger pullbacks, typically this stayed above the red line for a considerable amount of time, not briefly. So it's kind of it's not ideal. I would love to see the exposure stay kind of mid-range, but it didn't. But it's still, to me, it's not super bearish of a metric at this point. A lot of talk about taper and taper tantrum a little bit, and the Fed's talking about tapering in 2 years. So people, that's one of the reasons being given for this pullback. Pullbacks just happen, and there's always a reason given, but the pullbacks happen. The market doesn't just go up. And so far, I'm not seeing anything that says this is an abnormal pullback. It looks pretty normal to me so far. And despite this taper talk, balance sheet is still progressing higher at a pretty stable rate. It's been pretty steady. It continues to make new highs. So they're not tapering yet for sure. We did cross below the 50. First time in quite a while we've closed under the 50. We didn't even do it back here. Not a single close under the 50. We haven't closed under the 50 since back in early March, and that was a buy. And that's so my basic view is we come down to possibly to the 4100, maybe even a dip under. I think we may go a bit lower because you're sitting right at this kind of a logical support here at 4150. There's been a lot of activity here. There's probably a lot of stops under here. I think there's a good chance we come under 4150 briefly, get a little bit more pessimism built up. Then I think after that, potentially a bounce. And I think there's a potential similar to many corrections in SP 500 history, like the last one we had here, that we have kind of a double test type of look, double bottom kind of look. That's kind of what I think is a decent probability here. I don't see huge odds of going much lower. I don't think the odds are great that we've already bottomed. I think we go a bit lower and potentially double bottom. That's kind of my base case right now. And you can see that here. Yeah, I think that's it. I just wanted to do a quick video. I haven't done one in a while. I'll try to do one a month, I think is what I'm going to try to do. I'm trying to get one video out a month. Once a week was a little bit too much because I try to do pretty solid videos for you guys and not just the same stuff that you see everywhere else. It's a little bit more involved. It takes a little bit of time to do. But I'll try to do one a month like this. I think that's doable. I think it's a viable dip, like I said. But under 4100, potentially that's wrong. So adjust accordingly if the market can't stay above 4100. Obviously give it some time, like I said. But anyways, yeah, maybe I'll see you guys in a few weeks.